So now moving on to what are the big picture factors that determine valuation or influence it. The size of the market obviously is critical. The stage of the business is critical. What's funny about that is it's easier to raise money. I'm not saying the valuation is appropriate. I'm just saying it's easier to raise money sometimes for a company that's pre-revenue than post-revenue, right? Because post-revenue is like, well, how much did you ship last week? How much, what were the sales the week before? You know, suddenly you're into prove it mode, while you have a lovely option, a lovely business model and a killer market and a killer technology under development, you don't have to prove it yet, right? So it's life's easier. Those are different variables, obviously, than just valuation. What is the competitive landscape actually, right? You know, it's easy to pretend that you're in a unique market and your segment is just yours, but, you know, will that really pass muster in the market? What's the reality? If you're actually in a market where your best hope is to achieve 8% market share, do something else. I mean, honestly, my advice would be do something else. But the smart, if you're in a business, if you're raising money from smart investors, as I'll get into later, it is obvious, and as is obvious, they don't want to back companies that are realistically only ever going to be a bit player. And the fact is that companies over time, you know, this is one of those empirical facts. Companies that have less than 30% market share generally are going to have a really tough road to hoe, and those that have better than 30% market share are the ones to be in, as an investor and as an entrepreneur. So we need to have, that's a significant factor, obviously. And barriers to entry, there are nowadays, excuse me, because so many businesses these days online are dealing with consumers, there are many instances where the barrier to entry is we're going to kick ass, raise a lot of money, get the market, own it, build the brand. And that's our barrier because nobody else will easily knock us off. You could say that Apple has that down to a T. But in many instances, you know, it's great from an investment and valuation standpoint to have real barriers to entry, IP, patent protection, or other barriers to entry that make it hard to copy what you're doing, right? If it's a great idea and 3 or 4 other companies like it, are they going to be able to equal you fairly quickly? In which case, you know, that weakens the appeal, obviously. Strength of the team and the track record of the team is obvious. Momentum, there are companies that are doing boring things, but they're kicking ass with revenue momentum and profit growth, and they're exciting to raise money for and for investors to invest in because of the financial performance, right? And then we're in a whole different situation as to what the valuation can be. The majority of companies that are raising money in these forms aren't at that stage, but there are certainly some. We've got a couple we're working with right now. Momentum, but I would say, you know, you've got customer traction and you've got revenue momentum. Those are separate things. Customer traction, where you've got tremendous success and engagement from clients, and this is where the revenue bit maybe, you know, maybe you decide not to charge your early clients because you don't want to have to be in the prove it mode with revenues because they'll be so bloody tiny at this early stage in the game. You know, those are tactical methods that you might consider. But revenue, I mean, rapid growth in momentum, rapid traction, proof of traction, all of those things are obviously influences. It's almost so obvious I shouldn't say it. A less obvious one is when this company gets its business going, is the revenue going to be smooth or is it going to be inherently bumpy, right? If you're dealing with sophisticated investors, they care about that because it's harder to generate and support a high valuation over time in companies, public companies especially, obviously, that have bumpy returns. It's just much more difficult to sustain a high valuation. That's one of the reasons that software as a service, for example, valuations tend to be nicely high. Emotional appeal matters hugely in this online crowd investing thing that we're doing, of course, right? You can have a fantastic business, but if it's too difficult to explain or too boring, then you're probably not going to succeed at any valuation. It's not just about valuation, right? But that's a whole nother subject. I don't want to get into too much detail on that here. But emotional appeal makes it easier to justify a high valuation. Look at Tesla. That's an extreme case. I have these two terms I use, strategic and tactical. To me, a tactical company is a company that's doing something, and they may be doing it well. They may be very profitable. They might have decent profit growth. But when you look at what they're doing in the competitive landscape and the industry trends or the segment trends that they're a part of, you say to yourself, well, okay, this is a sort of a short-term thingy where I can make some money, maybe, probably, hopefully, but in the long run, where are they going to be? Is this going to be around even 20 years, 10 years from now? Yeah. To me, strategic companies are the ones that appeal and get the higher valuations when we're dealing with the more sophisticated investors, because the segment, the industry trends, the scale of the market is all there to be seen, and people will love that kind of company more, right? So obviously Tesla in the past, I was fortunate enough to be an investor in the venture fund, a venture fund that invested in Tesla in the beginning. Not that I've been smart about how I've dealt with my equity in Tesla since then. I've been utterly stupid, but let's set that aside and stick with the picture here. Okay, so strategic matters greatly, especially when we're dealing with savvy investors, and some of the investors we're dealing with online really are savvy. Okay, so rule of thumb for me, with those startups that I mentioned, I've had the good fortune to raise money from some of the best venture capitalists in Silicon Valley. Not in the last 6 weeks, but over time in the past. And I've done many investments alongside VCs and directly myself alongside other angel investors, a lot of that. And my experience is, as an entrepreneur doing on that side of the table and as the investor, that if you are doing a private round of that type, typically, it doesn't really matter. The company comes in with an expectation of valuation and how much money they want to raise. The VC will, or the investors will determine how much money they're willing to put in. It's cleanest and easiest to describe the dynamic with a VC, right? They will decide how much money they'll put in, and they'll decide what valuation they're going to go for. Obviously, if you've got a kick-ass, amazing company, or you're an exceptional, proven entrepreneur, the dynamics are different. But in most cases, you're going to get, if you raise enough money in this private mode to grow your company for a year and a half, then the fact that you can get the money says this is viable, right? The question then is, what dilution will you experience, which determines the valuation. You're normally going to get 25 to 33% dilution for that year and a half of capital. That's a rule of thumb that has worked well for me, and I've observed and experienced. And so, when you do successive rounds, you get successive dilution, and it can get to be a bit of a pain, right? But that's life. And capital enables you to do a lot of neat things. So it's not a bad thing as long as the VCs are great. In my experience of observing Reg A Plus very closely, legitimate offerings that succeed in raising money will typically experience half that dilution for the same amount of capital raised. That's a rule of thumb I want to give you to use just as that, as sort of a checkpoint thing to use. Don't use it and say, oh, well, Rod told me that must mean it's great, because I'm not approved to suggest it in that manner. But it's a public offering, Reg A Plus, right? So that makes the dynamics different. You've got there's other nuances I'll get into later, but that's a rule of thumb I've seen in private Reg D transactions, and I see it working in a similar manner in the way I just described with Reg CF and Reg A Plus as being. The thing you need to avoid with using this as a guide is that it's too easy, especially in Reg A Plus, right? It's too easy to be in a situation where you need 12 million. That's what it really takes. If you were raising money and getting heinous dilution from it, from a VC source, there's no way you'd take more than 12 million, but you don't want less because that's what you need, right? So the trouble in Reg A Plus is you're allowed to raise 75 million in a year. And if the marketing and everything else is kicking ass and you're raising the money successfully, woohoo, let's go ahead and raise a lot more money. In that instance, please don't at the beginning of the offering say to yourself, well, it's not 12 then, let's get 75 and let's use that percentage, because that's silly numbers then, right? You need to stick with if you're using this as a guide, use it with the amount of capital you would raise, and if it was difficultly dilutive, if you see what I'm trying to say there with bad English.